Good afternoon and welcome to this afternoon's session. My name is Cynthia Kerubo from Tax Education. I'd like to give the floor to Rosemary. Rosemary, can you hear me?
Hello.
Hello.
Cynthia, you can hear me?
Yes, I can hear you loud and clear.
Okay, thank you. Thank you for accepting to take us through this interest restriction aspect of the new changes. With me from my end, I have the RSM team, the managers, and also some of our seniors. And we are glad just to have this webinar to get through it. And out of it, I'm sure we'll be able to get to have a better understanding and also have maybe some of the queries that will be addressed at the end of the webinar. So welcome, and I hand over to you to take us through. Thank you.
Okay, thank you, Rosemary. I can see there are quite a number from RSM. Welcome everyone from RSM and all our other participants. So our presenter today is Mr. Nixon Omondi from Digital Economy. And before he comes on board, I'd like us to begin with a word of prayer. And then once he takes over, he can take us through the presentation. So we can bow for a word of prayer. Our kind and loving Master is above. We want to thank you for the opportunity that you've given us to learn. We ask you to be with us, to give us a teachable spirit, and that's a spirit of understanding so that we can even become more compliant and even more proactive in carrying out our duties as staff. We want to exalt your name and we want to thank you for this afternoon. Even as our presenter, Mr. Nixon is going to take us through the session. We ask for wisdom and guidance from above. This is my sincere prayer in Jesus' name. Amen. Okay, so Nick, good afternoon and welcome. You can carry on from here.
Thank you, Cynthia. Thank you, Rosemary. It's another wonderful afternoon. Re-engage on tax matters. It's even better when we take a narrow topic and see how far we can get. I hope I'm able to share my screen. I've seen quite very familiar names. Now that I'm not able to see their faces, I see James Karanja, Karibu Sana, my friend and brother James Muriuki. Thank you. I'm very honored to have you in this forum. And most will pick questions after comments once I'm done, so that if there's any question that might be addressed through the presentation, then that gives us a bit more time to engage on that in the slides. So we know that Cynthia, I'm disabled from sharing. Don't know if you are able to enable me share. Yeah, you able to hear me? Okay,
Yes,
good.
Nick. Yes, okay.
Not yet, still. And our dear listeners and taxpayers, as usual, if you find anything inconsistent with the law, we go back to the law that still is the guiding principle. I think that's better now.
Okay.
There we are. Let's see if we can share. Cynthia, confirm it's okay. It's the presentation mode and it's visible. Yes, Cynthia. Okay.
Yes, Nick, we can see
Good.
the screen.
Thank you.
Yes, and it's in
And
presentation mode. Yes.
good. And to our taxpayers on the consultants and participants, you're also free to use the chat box, Q&A, maybe to ask as we proceed. So when we look at interest restriction, we know that companies use various means to. I see Jilna's hand is up. I don't know what might be the issue. It might be my mistake. And Mr. Ndwati as well. Cynthia, am I clear or I'm having connectivity issues?
From my end, I can hear you. Sorry?
He's clear.
Yes,
Okay.
yes.
So we proceed. Okay. So this is what is up for presentation. It won't be a very long one. A small introduction. How is interest restricted? Just brought this out to have our mind that the method that we are using in Kenya is not all. We might be using many other methods that we is not directly captured in the law, but it's also in Kenya. What happened before January 2022, and then post 1st January 2022 under the EBITDA and interest restriction. And then I'll have a small example, very simple example, hypothetical, just to drive the point home. And there's several issues that we need to take into consideration. So first is, we know that debt is one way of financing business or project. When you have an entity, there are many ways of financing that kind of business. Either you can plow back profits, okay, or you know that in the Nairobi Securities Exchange, sometimes companies go public, they do IPOs or offers that are not really IPOs, subsequent offers. So they get capital used in expansion, for doing new project, for financing, working capital and all that. And sometimes it is the shareholders who are financed through equity. People take up shares and they pay up for those shares that they have taken up. Then there are also cases where you basically borrow, and debt is one of the main sources of financing the various activities in a company. And in general terms, you'll always hear of debt equity mixtures. So a company will be financed by debt partly, or by equity, or sometimes it's equity 100%, which might not be very possible 10 times. Also, or debt totally, and that is also. And I was taught somewhere in my finance management, financial management, that as a business person, you always look for the optimal mix of debt and equity. And generally, the more debt you use, the better for your tax paying. You save more to the shareholders, because the company is to maximize shareholders' funds. Okay, and therefore, remember, debt is paid up using interest. Interest is the result of a debt, together with the principal repayment. And when you use more debt, you basically also use more interest. Most likely you'll incur more interest. You incur more interest. Interest is tax deductible, which is allowed under Section 15, subject to the restrictions that we're looking at. And that's why we say that interest is a base eroding expense. Reduces the taxes payable, because as you take more debt, you incur more interest, might end up reducing your tax liability. So the companies can utilize the debt in order to reduce their tax. And basically, when we talk of thin capitalization, we refer to using more debt than equity, the funds that is coming from the shareholders. Some people call it you are over leveraged, you are highly geared, and such terms. And this was very practical pre January 2022 when we were still using ratio analysis. So there are three methods in which some countries or jurisdictions can use to restrict interest payments, given that interest payments are base eroding. And later we'll also see that interest payments or expenditure can also be used as a tool for tax planning. So there's the ratio method where you compute the debt, you compare with the shareholders' equity, look at whatever ratio is available. And if it exceeds a certain ratio, then you are told you are over-geared to that extent, or you are over-leveraged. And therefore, a portion of the interest in relation to the over-leverage being disallowed. Then we also have the earnings stripping method, and that is the subject of our discussion today. This is where we use fixed ratios based on earnings to restrict the income, and all of us, I'm sure, we are alive to the EBIT. And then there's also the arm's length method, and I'm happy some of you here are very technical people. We know that there's a chapter 10 that has been introduced in the OECD transfer pricing guidelines, and that deals with financial transactions. And even interest can also be gauged on whether the payment or the expenditure is arm's length within the comparability and the functional analysis mechanism. So there are also entities that basically use the arm's length method to check whether the interest expenditure that a taxpayer is claiming is really justified to that extent. So multinational groups, I've said, they can restructure their financing arrangements, and more so they might do it in order to take optimal use of debt, and so by so doing interest in order to do tax planning, not in a bad way, but even some have also done it in a bad way. There's always a tax efficient mix of debt, more so debt and equity in borrowing countries, that then can influence how the lender is treated. So there are cases, and we are all aware of Section 16(2)(j) again. There are cases where a debt is taken, that debt attracts no interest, and the issues of deemed interest comes in. There are cases where debt is acquired, the debt is excessive, or the interest rate is excessive. If the debt is excessive, then thin capitalization rules come in. If the interest is excessive, then the issue of restricting using the interest stripping method, or sometimes the transfer pricing analysis also comes in. And there are other cases where a debt is also restructured, especially the payment coming out of a debt under what we call hybrid mismatches. There are cases where you can't determine whether it is an interest or it is not an interest. And that is why it is important to come up with either thin cap rules together with the interest restriction rules to ensure that some of this, use of debt is not abused in a manner that then there's tax avoidance. So thin cap was introduced in 1988, the Finance Act number 10 of 1988. That is the first time we saw it being introduced under 16(2)(j). Has undergone several amendments. And the major amendment happened in the Finance Act of 2021, where we moved away from using debt equity ratios to a 30% of earnings. And in the old order, what was important is to check how the business is financed. And you could simply calculate 3 times share capital and revenue reserves. So if a company has a share capital of 100,000 and the revenue reserves of 200,000, the total will be about 300. So you do 3% of 300, that gives you 900. You compare that with all loans that the company has in its books. Because the law was talking of the sum of all loans being more than 3 times share capital at any time of the year. And I'll also mention something. because the issues around banks and financial institutions listed in the fourth schedule were exempt from this provision because their business basically is all about this. There's also the issue of loans, which is still existing even under the new order. The loan is defined and given a very long definition: loans, overdrafts, ordinary trading debts, or drawn current accounts. I remember there was a lot of issue when the issue of interest was being canvassed with respect to excise, whether other fees, and interest, whether we could use the Income Tax Act to canvass on excise and all that. But the definition of loan is very wide. When you're looking at a loan, don't just look at the normal loan that we ordinarily know about. Generally, anything that has a financial charge, interest, discount. So why thin cap restriction was as it was then is that there are cases where some companies would place high level of third-party debt in high tax countries. You'll find a country like Kenya that has 30% will be overburdened with loans because interest is generally tax-based eroding. Then the interest amount would be paid to another country where it is either not taxed or taxed as at a very low income. Then there are also cases where there are intergroup loans which generate excess interest compared to the overall group. You find certain companies, certain jurisdictions overburdened, and then there's also the claiming of interest. And also there are cases, again, we go back to 15.1, where a loan is acquired, interest is borne out of that loan, but the loan is used to finance a mix of both exempt and taxable income. So it is also important to have such laws to look into that kind of scenario. So this is an example of what used to happen before. I really don't want to belabor on this. Of course, we'll also be sharing this for further review. So if you had 1,000 interest expense in the 2020 return of income, let's say long-term debt is 30 million, there's no other debt. Remember, all loans include long-term debt, short-term debt, leases, so long as there's a financial charge or there's a premium. So if the long-term debt only is about 30 million, the issued and paid up share capital is 3 million, profits is 2,000, accumulated profits is what would be defined as revenue reserves. So how to calculate whether the company is thinly capitalized is by looking at 3 times the sum of 3 million and 2 million, that's 15 million. But you see all loans is about 30 million. We will say that in this scenario, the company is over leveraged, the company is thinly capitalized. We'll go about calculating to what extent is thinly capitalized by looking at that ratio, which is debt minus 3 times share capital plus revenue reserves divided by debt. And then that ratio gives you how much interest rate you should allow. So if the interest claimed or gross interest payment was 1 million, then it will be 30 minus 15 million divided by 30 million. That gives you 500,000. That would be treated as an add back. That would be disallowed interest. But when you look at that formula, several things come into being. What if your revenue reserves are actually losses? Because losses are part of the revenue reserves. What of cases where the going concern of an entity is under question? Therefore, the revenue reserves wipe out, and the accumulated losses wipe out share capital. Do we go into a negative, and then there's an interest payment which is more than what was claimable? Okay, how do you define revenue reserves? Does revenue reserves include capital redemption reserve? Is it capital or revenue? Is share premium part of the revenue reserves? Is revaluation reserve part of revenue reserves? It was a case of a lot of borderline elements treating some of these reserves as part of revenue reserve. What happens to non-residents with permanent establishments? Okay, are they also subject to this kind of scenario? And what is the definition of all loans, which I'll not label now? And the greatest problem we had was the highest amount of all loans held by the company at any given time during the year. if you look at that phrase alone, if you want to compute whether you are thinly capitalized at the end of the year, do you go back to a month where you had higher loans and lower revenue reserves and share capital? And how would you determine that? Because not many companies prepare monthly financial statements. Okay, there might be quarterly or semi-annual, but not many do that, and it might be also difficult and complex to be doing it. So this again is part of the issue that was felt, that the ratio, or this method, the ratio method of doing debt equity was not the most efficient, restricting the interest. And that then took us the interest restriction effective 1st of January 2022, where the Finance Act now replaced the thin capitalization method by ratios and brought in the internationally accepted 30% of earnings before interest, taxes, depreciation, and amortization. And as we discuss this, I know most of us are accountants. When you're looking at these terminologies, you need to have an accounting language, the practice, because that is how it is best. So instead of looking at the ratios, we are simply saying, ignore the balance sheet. Let's go to the profit and loss account. Calculate your earnings before interest, taxes, depreciation, amortization, which we christen as EBITDA. Okay, some people call it EBITDA, but I always call it EBITDA. And calculate 30%. If an entity has more than 30% EBITDA as interest claim, then that excess is what is supposed to be, or in our language, allowed. Why it was important to go this way is, one, the debt equity method restricted liability by thin capitalization based on debt equity. And it was easy to manipulate. There's actually a terminology, international tax, which is called bed and breakfast game, where companies will be thinly capitalized during the year, but as the year end approaches, they will either repay the loan or show up their share capital through share premium. Then they end up not being thinly capitalized. That's what they call bed and breakfast. Or they will repay the loans to ensure they are not thinly capitalized. So to ensure that is taken care of, then we needed to move away from the debt equity to the earnings before interest, taxes, depreciation, amortization, which is not easy to manipulate. Two, there were a lot of technicalities offered by the ratio analysis, which we have looked at in terms of what is revenue reserves. Okay, how do you confirm that at just any given time you are thinly capitalized at any given time of the year? And more so, it is an international global best practice. So let me say global best practice. What we implemented is part of Action 4 of the Base Erosion and Profit Shifting Project in the OECD and the framework. So EBITDA is usually a more effective, favorable ratio. Actually, if you look at a lot of documents by the IFRS on EBITDA, there's been a discussion whether IFRS should be part of a line item in the profit and loss. We call it the statement of profit and loss and comprehensive income statement, whether it should be given its own line. And there's been a lot of debate with some people feeling it's not necessary. Others are feeling it is necessary. And why EBITDA has elicited such discussion is because most people feel it's a better economic performance indicator, that shareholders, people who analyze companies, usually go for this EBITDA. They're doing the analysis on how good, how bad the company is doing. Two, this method is straightforward. You don't need to look at any time during the year. You don't need to be calculating what is share capital, what is shareholders' equity, what is revenue reserves. Simply go to 30% multiplied by the EBITDA. So it's a more straightforward approach. But of course, you usually say the devil is in the details. It might be straightforward, but there are nuances around it that still need to be navigated. Then two, because the ratio is just simply looking at the interest and the earnings. Whatever amount you raise is not a problem. So you take as much loans as possible. Take loans at 1%, at 2%. Of course, if you take lower than 1% at zero, you might also run the risk of deemed interest. So it doesn't restrict any entity from taking further loans from third parties, all such people. I also wanted to mention at this stage that Kenya chose at 30%. The internationally recognized ratio is between 10% and 30%. When you look at a lot of commentaries, the 10% is advocated for where a company is doing what we call clawback or carrying forward. So anytime there are cases where countries or tax jurisdictions allow taxpayers to carry forward any disallowed interest expense, or they can carry back. You remember the issue of losses, section 15. Whether you have losses, you carry forward the losses. Because we had 10 years, then we've gone into it definitely. So in some countries, they also allow for carry back, like the one we have in the main schedule for oil and the mining companies. So in some countries, they allow you. If you've been, your debt equity ratio is, let's say, 10% or more, they have disallowed a portion. You can carry forward the portion that you've disallowed. You can carry it back based on your financial. And they recommend for the lower rates to allow for the carry forwards and the carry backs. Where there's no mechanism like that, like the Kenyan situation, then they allow or they advocate for a higher rate. And that is why Kenya went for the 30%. So this section, as currently worded, 16.2J, applies to all loans. Remember, all loans is defined, and I don't want to belabor on that. In addition to the issue of interest on all loans, it also applies to payments that are economically equivalent to interests. So any payment that resembles an interest will actually fall under the interest mechanism. So you look at a premium, you look at a discount, and such like terms, they will be under interest. Then it also adds expenses incurred in connection with raising the fund. Remember, when you are borrowing, there are arrangement fees, there are negotiation fees, there are valuation fees, there are processing fees. There are cases where you also have legal fees because you need to draft arrangements. And my senior here, James Karanja, will be there to endorse such arrangements as an advocate of the High Court. So all those fees will be treated together as part of the interest when you are looking at 30% of EBITDA. Then what is excluded, of course, in the Finance Act of 2021, only banks or financial institutions licensed under the Fourth Act, under the Banking Act, sorry, were exempt, and the micro and small enterprises registered under the Micro and Small Enterprises Act. So that then gives us a difference between what was originally in the 16.2J and what was changed in the Finance Act of 2021. The Finance Act of 2021, it's only excluding banks or financial institutions licensed under the Banking Act. Before then, 16.2J was not applicable on financial institutions listed under the fourth schedule. So that is a difference that all of us should know. Then Finance Act 2022 added more exemptions, added the MFIs, which are licensed, and also the non-deposit making. So you are looking at non-deposit taking, you are basically looking at any MFI which is deposit taking or not, as long as it is under the MFI of 206, Microfinance Act. Then we have those who are listed for hire purchase, those who are doing leasing, section 6.2, companies that have been licensed to undertake human vaccines. You know that in the last two or so finance acts, seen a lot of exemptions, and the government trying to bring up companies that can manufacture human vaccines under special operating framework arrangement. Then we also have those who are doing cumulative investment, at least 5 billion, okay, and those who are manufacturing and have investments which are more than 5 billion outside Mombasa and Nairobi. And also those companies, holding companies that are in the CMA, they're also not subject to the thin cap rule under 16.2J. That also now brings the question as to these loans and interest, both local and are the loans only local or foreign? And plain reading of the law is that all loans, all interests are covered unless there is exemption. So that is something that we need to be aware of. Okay. Sorry. Move forward. So this is how the law operates, the income. You will remember 30% of the EBITDA, the interest restriction law, is currently law. Step one is to calculate the measure of earnings. So what you are basically doing is to calculate the entity's EBITDA. When you're calculating the EBITDA, remember when you look at IFRS 1, I told you this one, we look at the accounting records. You look at IFRS 1 on, actually IS 1 on presentation of financial statements, you'll see there's usually the turnover, and then you come to profit before tax. Then there'll be notes on how the profit before tax was done. And then you go down to those other expenditures and all that. So you need to look at that profit before tax and do adjustments to arrive at the. How do you do it? You add back to the EBITDA. Actually, this should be not taxable income. It should be you add it back to the profit before tax. Any gross interest expense. So if you're starting from earnings before tax, then you have to add back the interest, okay, and payments equivalent to interest, as I've explained. And two, you also add back depreciation and amortization. If you take the figure like earnings after tax, then you'll add back the tax, add back the gross interest, and also add back the depreciation and amortization. More than that, the law further provides that any exempt income will not be part of the EBITDA. It should not be forming part of the earnings. So exempt income, if you look at the IFRS, IS 28 and all those other FRSs 9, 10, thereabout, where you have consolidated accounts, taxation of associates, and joint ventures and all that, any income, either as dividend, which is exempt from tax. In Kenya, we know the withholding tax is final. There's no further taxation of dividend. If dividend income is forming part of the EBITDA, then you'll also need to deduct it, not be part of it. Two, income from associates. So if a company has listed as part of their incomes, in the calculation of the earnings before tax, the profit from associates, that should also not form part. So those will actually be deducted, not added back, because they were added as income. The rationale is interest will only be claimed which has been wholly and exclusively incurred of the taxable income. And that is in line with Section 1. And then once you've calculated the earnings, which is the earnings before interest, taxes, depreciation, and amortization, then you go to apply the statutory benchmark ratio. So you do 30% of what you have received. So if you've gotten a figure of EBITDA, multiply 30%, that gives you the maximum deductible interest expense. And the last one is to compare how much you are allowed to deduct versus how much you have actually paid or incurred. And the difference, if it is excess, for example, if what you have paid is more than the maximum deductible amount according to the 30% of EBITDA, then that balance is out. I think I'll take it home by giving an example shortly. This is an example of what we have. Team, you have an entity, ABC, where profit after tax is 1.4 billion. This is in shillings million. And then interest is 1 billion Is it one? Yes, 1 billion. Taxes 600 million, depreciation 300, a loan arrangement fees of 20, and amortization of 50. So if you want to work out the EBITDA, remember we are starting with profit after tax. There are cases where you'll start with profit before tax, so you'll only have 2 or so adjustments. If you're having profit after tax, then you also need to adjust for the tax. So you'll add back the tax, you will add back the interest. And remember, interest, we said, is its interest plus payments equivalent to interest plus any expenditure incurred in the processing of the loan. So that means interest will be 1,000 plus the 20, which is the loan arrangement fees. And then you have depreciation, which is 300, amortization, which is 50. There are cases where you will not see these terms, amortization, depreciation, because I know accounting standards are evolving. You might see things like impairment. So then those ones will form part of it. So the subtotal in that case is 3370. That gives you the EBITDA. So the maximum allowable interest to be deducted is 30% of 3370, which is 1011 million. That's 1.011. Then what is disallowed? Remember, the interest paid was 1,000, interest paid or payable. So the net interest, what will be disallowed will be the 1020. It is the interest plus whatever is deemed to be interest. That's the loan arrangement fee plus the interest, minus what is maximally allowable, which is 30% of 3370. That gives us a 9. 1020 minus 1011. So 9 million will be added back. Remember, the EBITDA we are doing is accounting. You will still need to go forward and have your profit before tax, then add back, disallow, and do all those other things according to section 15 and 16, and come up with your taxable income. So under your disallowables, the disallowed interest based on EBITDA, yeah, the disallowed or disallowable item. Good. So actually, I'm on my last slide, but I'll be ready to pick up questions after this. Key things that have come up. When was it starting? It's any accounting year ending 2022, from January 2022, or starting. And I think our policy unit had guided that we needed to apply it any accounting year that was ending after 2022. And we can still discuss that further. The number 2, the way the rules are now, it is applicable to both local and foreign loans, whether they are controlled foreign or not. But I know there are cases where our policy have also guided that these rules are actually meant for loans which are coming from outside Kenya, interest paid to people who are not in Kenya. And that is in line with the OECD principle that the ThinCap rules about related party loans or interest paid to related parties who are based in different tax bills. Then the issue of EBITDA is an accounting term. So you'll see it in the presentation of financial statements. Then the issue of other comprehensive income. Look at IS1, other comprehensive income is reported separately, and it also doesn't form part of EBITDA. The issues on gain or loss on strategic equity securities, gain or loss on property revaluation, gain or loss on actuarial gains or losses on defined benefit pension plans. They're usually reported as other comprehensive. They actually don't form part of EBIT or EBITDA, what we call earnings from ordinary activity. Then there's also the issue of interest can be gross, or in some cases can be net. OECD recommends, and I'd also explained this, that a country can agree to do net interest or gross interest. Our law, if you look at 16.2J, is very clear. It's about gross interest payment. So it is very clear, not net. But the OECD provides under Action 4 report that where you're using a net is where the interest is not subject to further taxation. you know, for interest to companies or corporate bodies, it is not qualifying. And actually the withholding tax of 15%, then again charged as an advance tax. So you will pay the 15, report the interest income, and then claim the 15% as an advance tax. And then issues around transfer pricing doesn't add with income. So even after doing not income, the interest restriction, even after doing interest restriction at 30% of EBITDA, our international tax office is still capable of looking at the interest that is being claimed, whether it is really arm's length or not, according to Chapter 10 of the pricing guidelines. Withholding tax is also applicable despite the restriction. Okay, so they still go together. And then the disallowed portion of interest for related party transactions can still be deemed as a dividend. And you know, after amending the law in 2019, Section 71B5 of the Income Tax Act provides that there are certain adjustments, especially where there's a related party transaction, where we are disallowing a portion, we are doing an adjustment because of related party transaction, we can still treat that as dividends, what we call secondary. We can deem it to be a dividend. And of course, there's no grandfather exemption. There are countries where they give what they call grandfather exemption, like loans that were acquired before 1st of January or before the law came into being. You know, all loans are now treated similarly, whether you acquired the loan earlier or you acquired the loan after the law became effective. So yes, Cynthia, I think with that, I can pick questions and comments. Because there's already a question by an anonymous attendee, but we can leave it at that.
Thank you, Nick. I'm just informed that the chat is inactive. I think maybe it's because I shared the host, right? So you can be able to share the presentation.
So I
think
I can take it back to you.
Yes, if you don't mind.
Let me see if it's possible.
Mm-hmm.
Okay, just a minute. So I make you host.
Yes.
I've seen Wanja and Duncan. Karibuni sana. You're still using the coordinator name?
Yes, tax education.
Tax education, just analyst. Okay. So I make you host. That's okay. Confirm you're able to see it. Good.
Yes.
Okay.
Okay. Thank you.
So even as you enable our attendees to ask questions and provide comments, someone is asking, what about for entities that have fair value gains on biological assets? Which are part of the P&L as per IAS 40, and also those that report fair gains on investment property as per IAS 40. Should this be adjusted in the EBITDA? Yes, the question is it, first of all, on fair gains on investment property? It basically should appear as other comprehensive income, so it will not appear in the EBITDA. On the fair value gains on biological assets, we need to look at this together with Section 17, Taxation of Agriculture. Is it a taxable income? It's an exempt income. If it is, then it will also not form part of the EBITDA. And engage much more on this. Remember, our policy unit is also alive. You can put your specific request so that it's looked at in light of 5 of the TPA on private request for guidance. Okay. I hope our anonymous attendee has some response. Cynthia, you able to hear me?
Yes, Nick, loud and clear.
Good, good.
Yes, I think
So
the chat is open. And I've also made Jilna Shah as one of the panelists so that in case there's any other challenge, we can get assistance from that end. And I also think it's possible to unmute. So Nick, if you don't mind, we can unmute a burning question.
No problem.
Through raising of the hand.
No problem.
Okay. John, you're unmuted. You can go ahead.
Okay, good afternoon all, and hi Nixon, and thank you for your presentation. I would like to ask one question or two on the issue of Forex, be it realized or unrealized. How should we go about it? Because when the Act says about economically equivalent of interest, do you assume even the Forex, because when you acquire foreign loans in foreign denominations, and when you are paying, there is that charge that you pay or the Forex gain or loss, depending on the booking value and the payment rate. So how should we treat that? And for the balances like the one that we are carrying forward from the year 2021, should they be, how should we treat them in the current year tax computation? And then the other question is around where you have different sources of income. I think the question that has been raised is whether, for example, you have business income and you have rent income, and maybe the loan element is because of the rent business. How should we treat that? Should we assume that that amount should go to, or we restrict the base the beta based on the rental income, or how should we go around it? Thank you.
Very good questions, John. Just one clarification, John. Cynthia, don't mute him still. I wanted to know the balances. What balances being carried forward to 2022? The 2021 balances.
The unrealized Forex gain or losses which were which now in the current year you deem them realized.
Good. Yeah, we can pick 2 or so more questions. Then we deal with them at once.
Okay.
Hello, Cynthia?
Hi, yes, we can hear you.
Okay, thank you. Thanks, Nick. Thank
Yes.
you, Nixon, for a very good presentation. Following on from John's query on the issue of deferred, the deferment of Forex losses, which are deemed realized, the Act provides for, under Section 4A, a Forex loss shall be deferred where it's realized, and then you apply the 30% restriction. So when you say deferred, does that mean 30% is what I can claim in this year, and the balance of the amount which is realized, I carry it forward and claim it the subsequent year? So just to add on to the Forex part of it as well. Thank you.
We pick one more, then we deal with them.
Okay, I don't seem to, there's no other raised hand. Maybe we can take that for round 1.
Sorry, can I just add? Sorry. On the other part, for the exemptions provided, as you said, banks and financial institutions and the likes of non-deposit taking institutions, you've mentioned their lending and leasing, non-deposit taking institutions involved in lending and leasing. But say, for instance, a taxpayer is only involved in leasing, for example. Does that mean they will not qualify, or they will qualify? If you can also clarify on that, because the wording is it's a bit too strict. I thought they would have been intending to such industries being provided the exemption. So I think that would have been the principle. But if you can clarify the same. Thank you.
Thank you. I think these are very good questions, very technical. And John, partly Gilna has already rescued me by answering the question on Forex. Remember, Finance Act 2022 attempted to align the two restrictions. So if you look at Section 4A amendment, simply aligns the restriction just like Section 16.2J. But I know if you look at it, there seems to be a bit of complexity about it. Further, remember the law says deferred. The law never says deferred to when. And there have been a lot of cases on the issues when a Forex gains realized. There's the realization as canvassed in actually two very great cases on whether realized means paying out or means just recognizing in the account. But I think the latest judgment is about the actual extinguishing of the asset. Remember, the Forex relates to loans or transactions that you had with third parties, basically related persons, and it's on interest, not on anything else. So what you'll do is to also do 30% on that. So you will do it the same way we have calculated on interest. Do 30% of EBITDA. That will be the maximum allowed Forex gains. So that doesn't look very, 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 very real when you do it, because it might connote a very high figure for Forex losses. But that is what the law reads. That is what the law is. And then on the issue of, I've already answered also the balancing, because the law doesn't say you defer to next year. It's only an industry thing that push it to the next year to do that. But I always tell people the law doesn't say you defer it for how long. And the law doesn't say it's the next year. It just says you defer it. Does it mean forever or the next, the subsequent financial year? Then on the issue of different sources, if the rental income, for example, because you're looking at specified sources of income, section 15.7E, together with the other sections of the law, if rent is not forming part of the income which is presented in the EBITDA, then interest in relation to that rent not to be allowed. For example, if you have an MRI, let me give a hypothetical. You have an MRI, and you also have other businesses you're doing, and you've got interest expense. You incur it on the interest, none of it will be allowed. If you incur interest expense or the loan is used for the business and the rent of properties, of course, you might end up apportioning based on that. And that's where the law comes in terms of what is exempt. It will be exempt to that extent because the loan has been acquired to do the two businesses. Interest can only be attributable based on whatever metric that we'll choose. So that exemption is still very important to take care of and know whether that interest expense is attributable to which business being presented in the face of the accounts in coming up with the EBIT and the EBITDA. The lending and leasing, yes, I agree with you, Gilna. The law is quite restrictive. Maybe we might need the idea of the policymakers as why they felt non-deposit taking. But again, if you look at deposit taking, most of them will be licensed either as a bank, or such like an entity. Might be covered somewhere else. But I agree with you that the moment the law said non-deposit taking, lending and leasing, then that is quite limited. If you are doing both, you are not licensed under the CBK Act. Again, there are certain businesses, lending and leasing, that not do unless you are licensed under the CBK. So that's also important to mention, but it's a very good question. And it's not regulated. So we look at the law as it is licensed under the Banking Act, not regulated under the Banking Act. But again, I would wonder why an entity is licensed unless a bank. Okay. So this leaves out a number of entities that are doing lending, leasing businesses. Okay.
Okay, thank you, Nick. We have another question from James, and I think a concern from Adam. James is asking, is there a likelihood of exempting interest on local loans from restriction in subsequent legislations, say in Finance Act 2023?
James, I think that's a very straightforward question, a good one. I hope, James, you made your proposal through the various channels available so that it's looked. But now I cannot comment on it because I'm not in the know whether they are. But we should be ready to forward our proposals to exempt local loans.
Okay. And Adam is also saying, I am assuming biological assets, fair value gain or loss will be adjusted in coming up with EBITDA.
EBITDA, yes, he's right. It will be part of what will be adjusted.
All right, those are the questions I can see on the Q&A. I'm trying to see if there's a hand raised, but I can't find
there's
any.
Jilna is back.
Sorry, sorry, I seem to have many questions, it seems. So thank you, Nixon. Regarding, actually back to section 4A, I'm still a little concerned about the way it's worded. It says, where foreign exchange loss is realized by a company whose gross interest paid or payable to related persons and third party exceeds 30% of the company's earnings before interest, taxes, obviously the EBITDA. So in an example where we have, where if the interest is still below the EBITDA limit, the 30% of the EBITDA, but the Forex realized, for example, is more than 30% of the EBITDA. Does that mean, so I'll just give you an example. If 30% of the EBITDA, which is 100, comes to 30, my interest is only 15. And say my Forex is 45, just giving an example. What would be the situation in this case? If you could just explain to us with some numbers, it would be very, very helpful. Thank you.
That's a very good question, and also very technical, because what the law seems to do is to peg the interest and the Forex in a similar manner. If you look at it critically, it's like when you are paying more than 30% interest, then again, corresponding amount should also be disallowed for the Forex. That is basically what it's being said. So then, in any case, your interest is below 30%, or it's up to 30% of EBITDA. Even the Forex will not be. So it's just as simple as that. Gina, does it answer our question?
Yes. And then would you also consider that as part of the interest in, say, the Forex amount? Do you also add it as part of the EBITDA in the EBITDA workings when calculating EBITDA? To be fair,
Forex will appear just like, and remember, it's if it's a cost related to the loan, it will also be part of what we adjust in the calculation of EBITDA.
Perfect. Thank you.
Yes.
Okay. John, I think you're back. You have a question?
So Nixon, just one question on these exemptions. Just to add up on Jilna's question. So if a company like now those who do lending businesses, they are non-deposit taking, they are not registered under the Banking Act, and they are neither they registered under the Microfinance Act, and maybe they get loans which they again lend and earn interest on. So in this case, even if the act is doesn't include them under that exemption, technically saying their main expense will be the interest that they pay, or the finance cost that that they pay to their lenders. Now, what is your take on this?
Yes, James, it's a very good and challenging question at the same time, because we know that the law is to be implemented as is. We cannot just infer. And sometimes that is the unfairness that comes with this law. So if they are not part of the exemption, then again, it might look unfair on them, but that is what the law is, John. So I don't think there's any provision exempting them. Maybe unless you make a specific request, but all of us also know the issue of exempting of income from exemption. But again, I still believe the law is very clear on who is exempt and who is not. But more than that, John, will you be doing such kind of business without being licensed by CBK in Hawaii? Of course, you might not be in the Banking Act. A challenging question, I get you, but it might look very unfair on those taxpayers, but that is the law.
Okay, because we have like those that are like say those are the digital lenders which are trying to formalize their transaction by registering with CBK. So that is where the challenge is, because if your major expense is the interest or the finance cost that you are paying, and your income is interest, so it becomes quite a challenge.
It's a challenge, but I will suggest, John, you can do a request for private ruling so that you are guided in a more official and informed manner on whether it will look unfair to subject to those kind of entities 30% of EBITDA. Well, we know that the interest expense is actually there 90+%. It will be interesting to have such kind of an application.
That is noted. Thank you.
Welcome.
Okay, I think that is it, Nick. I can't see any more questions, neither can I see a hand raised.
Cynthia, I think there's a question on the QA chat box. Just check.
Cynthia, I've seen the question,
Okay.
and I think we had partly answered it, that if you have borrowed and the forex that is coming up is simply akin to the interest, so they'll be treated together as interest. When you are adjusting for EBITDA, you need to remove the forex, and also now you need to also restrict it based on OA. But what our attendee is asking on forex on losses on trading, this would be an interesting area to look at. It losses on trading normally or losses on trading with related parties. Our law doesn't talk of related parties or parties within, everybody is subject to these rules, the interest restriction rules. OECD is a bit on, let it be on related party, for example, interest, or where the loan is guaranteed by a related party. Then any interest, negotiation fees, arrangement fee, guarantee fees, then should also be restricted. Now where the losses, the forex losses coming out of the matters which are trading, then our law will not cover them. I don't think they'll be covered under either Section 4A. Section 4A is a bit restricted to the issue of loans as well. And that is the intention of the law. Okay. So that is what I can provide to our attendee for now, but I think it can still pick up. Okay.
Okay. So there's one more. Nick, are you able to see the question? It has just popped up.
Yes, I think we've answered this. We've answered both for trading. We've also answered forex, and then in relation to Section 4A. Yes, maybe our attendee just want us to repeat, but I think it's covered already.
Yes. And also to add on that is that this session was broadcasted live, or has been broadcasting live on our KRA TV. So if you go to our website, www.kra.go.ke, you'll be able to find a recording or a replay of this very session. So in case you need you need to make a point of reference or something, then you can always get this recording on our KRA TV. So after that, I think we are good to go. I want to thank all our participants for finding the time to join this call, and to thank my fellow panelists and also our presenter, Mr. Nixon, for that wonderful presentation. I'm not sure if we have another of such session, but if we do, I think we'll invite you, and you can also join whenever ready. But thank you everyone for joining. I wish you a good evening ahead. And Nick, maybe you can give us your parting shot.
Thank you. Just a part of, to clarify the last question, that the OECD talks of forex on the borrowing. So all this should be with respect to the borrowing, and that is what is actually being restricted. Thank you for the very good questions. I think the discussion can never get better. Let us not stop discussing it now. We can engage offline, and I will be glad also to receive a part of letters for purposes of guidance on Section 65 on private rulings. But above all, thank you, and meet you again next time.
Wonderful. So thank you, everybody. And we are free to leave at one's own pleasure. Thank you.